Inflation skyrockets, generating panic in the market.
In terms of inflation going
But there was some hope that inflation might...
Every near-term inflation trend.
Looking at where inflation is, we've
down inflation, and that is priority
now is inflation.
Inflation report, which...
The overall price increase has left not only investors, but cryptocurrencies on edge. Bitcoin, in fact, has stooped down to levels unseen since December 2020. But why has inflation become such a significant issue for markets? In theory, the idea of inflation need not be negative. In fact, for as long as the United States has been on record, the year-on-year inflation rate has almost always been above zero. However, the data is now quite worrying as we're facing the highest level seen in the US over the last 40 years. Moreover, the Eurozone is experiencing the highest inflation in history. In recent months, it has risen non-stop. The reasons behind this price increase include the war in Ukraine, energy costs, as well as the issuance of money by central banks to inject liquidity into the economy. Now, we're going to stop and take a look at the role central banks play in regards to inflation. The Bank of England, the Federal Reserve of the United States, and European central banks possess an extremely powerful tool to regulate monetary policies.
The committee left the target range for the federal funds rate unchanged.
I think it is likely that we will raise rates again. I think it's more likely than not.
As I have said before, it is very unlikely that we will raise interest rates in the year 2022.
Interest rates are an essential instrument used by central bank policies to control inflation. Basically, when interest rates rise, the price of money rises. We could say that it becomes more expensive to borrow money. This makes access to financing more challenging, while business investments and consumption slows down. And a reduction in consumption means a fall in prices, but central banks must be very careful when using interest rates. If cheap money is abruptly ended, meaning if central banks raise interest rates too much, the economy may fall into a recession. Technically speaking, a recession involves the contraction of a country's gross domestic product over 2 consecutive quarters. The fear of this is on everyone's mind.
Well, no, that's why I think we are increasing the odds of a recession.
Concerns about the economy and recession, so that they won't go.
Many households this year, it will feel like a recession.
Qui est même entraîné un risque de récession.
Estamos acercándonos o no a una recesión global.
In 1981, the US Federal Reserve raised rates to 20% to contain worrying inflation figures. And this mismanagement of the money supply, of liquidity itself, caused a recession, and unemployment went through the roof.
But the dark cloud of unemployment hangs over the lives of 11 million of our friends, neighbors, and family.
One of the most important tools to predict recessions is the well-known yield curve. With it, we can get a good view of investor confidence in the short and long term. When the market is healthy, it is natural to see more confidence in the short term than in the long term, and therefore debt yields are higher at 10 years than at 3 years. But when fear sets in short-term confidence falls and debt yields rise. In short, if you pay more interest on short-term debt than long-term debt, it is a bad sign. This is known as an inverted yield curve. An example of this was witnessed in 2008 when the curve served as a warning of the economic catastrophe. Now we're not in a financial crisis such as back then, but panic has definitely made its way into the cryptocurrency market. Bitcoin, together with Apple, Facebook or Google shares, are all considered risk assets that experience the economy's ups and downs. And let's not forget inflationary issues. But why do stock markets react to inflation data? Quite simple, due to the fear that central banks will bring out the big guns and raise rates, causing a recession. And this fear of recession is what makes investors shake and drive traditional markets down even before a recession hits. This year, inflation is out of control, and to this, we must add the country's growing debts, the supply chain crisis, and the Ukraine war. The main central banks are already bracing themselves as they draw the line and adopt what's known as a hawkish position.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point.
The Fed is carrying out the biggest rate hike since 1994, 75 basis points in one shot. This will inevitably affect markets as well as the entire economy, even with a recession. As we have seen in recent years, these earthquakes also shake cryptocurrencies, so it is impossible to predict the impact of the crisis on the price of Bitcoin. What about you? Do you think Bitcoin will continue to sink? Have central banks made the right decision? Leave your comments below.